Welcome back to the BHF Boardroom Series. I'm Matt Hughes, founder of Accommodate Consulting. This series is about the judgment calls that sit behind performance in hotel businesses. Not what contracts say on paper, but how decisions play out over time once a hotel is open, trading, and under real pressure. Across recent episodes, we've explored operations, leadership, brand, and execution. Today, we're turning our attention to something that quietly shapes risk, leverage, and long-term outcomes, but is often only revisited when something goes wrong. Franchise agreements, and more specifically, how they behave in the real world. I'm joined today by Felicity Jones, consultant at Misunderstandings, where she co-chairs the EMEA Hotels team. Felicity advises owners, operators and investors across the UK, Europe, the Middle East and Africa on hotel and resort transactions, operating arrangements and franchise relationships, often where legal, operational and financial realities intersect. This isn't a legal masterclass. It's a practical conversation about risk, leverage and long-term judgment across the life of a franchised asset. Felicity, it's great to have you here.
Very good to be here, Matt. Thanks very much for asking me. As you said, I'm the corporate team at Mishcoms. We do buying and selling, refinancing. I've joined them fairly recently. There's a wealth of experience in the firm, which is very exciting for me. So I have the support of a very solid real estate team, leading real estate, leading litigators, real estate finance, and everything down to the IP and the procurement. So it's exciting times.
Before we get into franchise agreements in practice, it would be helpful to start with a bit of context. Your role at Misunderstandings and the types of situations owners, operators and investors most often come to you for support on.
Well, the ideal is we see the life cycle. So we buy the asset, we help finance the asset, part of which is the management or the franchise. If it's going to be a branded property, we will help them with the procurement, we will help them throughout the life cycle. But I know that for this, we're focused on what happens once the agreement's been signed. It's predominantly about money. It's whether the brand is actually performing. And the brand will always take the view that the owner needs to fully understand and work with their system. And in many cases, they're right. But there are many stranded brands. The brand operator, all of them are increasing the number of brands they have. Their attention to some of the older brands isn't quite what it might be, and they've got really long agreements. And if it's a franchise agreement, there are very few termination rights for an owner. So we have to be imaginative.
Yes, the brand landscape really has got extremely large over the last 5 to 10 years across all the major brands as everyone expands and tries to get into the asset light and capitalize on the asset light model. To ground this a little, is the conversations that you're having usually triggered by funding pressure, or is it operational performance, brand delivery, or I guess some combination of all three?
Earlier we were talking about legal and commercial risk, and this is like all three. It does merge, because if a hotel isn't performing from an owner's point of view, it's not producing the income it should be producing. At the same time, they're paying fees to the brand, and they may be coming under pressure to refurbish. You can understand the brand wanting to maintain a certain quality. Do they do the same across all their hotels in that brand is often questionable. So you have the owner coming under pressure from the government, from business rates, from employee taxes, the brand pressurizing because it's a change in brand standards or because it's time for a refresh. What owners don't seem to necessarily understand is the person that they're dealing with. And there are some great developers, and they're universally an interesting bunch of people, and they want to do the best for their owner at the time. Once the agreement's signed, you're not dealing with the same people. And you're dealing with an agreement that you were probably told, oh, we can't afford to upset our owners, don't worry about this provision. It'll be fine. But it does mean that owners will sign up to having virtually no rights of termination. Because if you look at it, effectively, there are no real obligations. A franchise agreement is a license to use a system. Very rarely will it say, we will maintain this brand, we'll make sure that X hotels are open. You've got to be fair to both sides, so you have to use the system properly. But there will be times when the system either isn't really fit for purpose or the brand isn't fit for purpose.
So that badge above the door doesn't necessarily guarantee performance. And so that moment in time, that negotiation before a franchise agreement is signed really is critical. And so owners need to understand what it is that they're signing up for and what they're possibly not going to get.
Yes. And of course, at that time, the one person everyone's going to be able to dislike is the lawyer, because we're the ones saying, well, what about?
Never. Lawyers are lovely people. Why would they?
You have to have a positive approach. You have to balance the fact your client wants this brand. They want to take the risk of that brand. They want to take the benefits that may very well be there. But it's quite interesting that a brand will very rarely say exactly what it will deliver. So you're going into the dark art. We'll come to transparency later, but you're going into a dark art. So there's no provision to say, if we're not providing this into your hotel, you can terminate. Yes. Then to be fair to the brand, if it's not an experienced owner or an experienced third-party operator, they may not make best use of the system. So you have to have a balance in there. Yes. So this isn't an anti-brand mindset at all. It's just, if you want to be there, why won't you at least show that you will help the owner to achieve a certain level of income? Yeah. Or a certain level of occupancy.
Earlier on, you mentioned feasibility, and I think it's such an important part for owners to really have a thorough feasibility study, but also conduct their own financial modelling to look at all the different scenarios, how it's going to play out. Especially, as you say, there's not necessarily guarantees from the franchise or from the brand about performance. And of course, so much can change over what could be, as you say, a long agreement, 20, 25 years. Where do you see the line between commercial risk and legal risk blur? And when does it generally become a legal problem rather than a commercial disappointment?
It's a legal problem if you want to do anything about it, because this comes back to many franchise agreements will have no right to terminate for an owner. They may have what's called a liquidated damages clause. So that if the owner has breached and the brand decides not to suspend the system, but to terminate, then there will be 3 years, could be 5 years of annual income that they will seek as liquidated damages. And just be warned, that isn't the only damages they can seek, because if you're in breach of something else, they could increase that. And many owners, with the goodwill they've generated with the developer, will think, oh, we can terminate on 5 years or 3 years. They can't. They've got to behave badly enough or be bad enough that the brand wants to terminate. And there can be a long run up to that. So it can be a very disappointing trade for a long time before an owner can do anything about it. So you try a material breach clause, and often it will be accepted. But then if you look at the agreement as a whole, it goes back to my point, it's a license. Here is the system, you use it. There are not many obligations. So I think an owner really needs to look at their feasibility and understand that if a brand is focused on rooms, the developer just wants more rooms, you can have another brand with the same operator nearby. It can be a new, fresher lifestyle brand. There can be different rates in it. Even the effort of negotiating an area of protection, which will only be brand specific, should show an owner that there are other interests at play from the brand's point of view.
Yes.
That doesn't mean it can't work. But
no, of course. Things change as well, don't they? I think it's something that's come up a lot on this show. I always talk about, from an owner's perspective, motivations and expectations. But I think it's just as important that the owner establishes what the brand's motivation and expectations are. If a brand is responsible for reporting the net present value of a contract for the whole length of that contract, then they're not going to necessarily walk away from it, or certainly not going to walk away for it without those liquidated damages. So that owner understanding that if they're looking to flip or exit that property 5 years, 7 years into the agreement, what's that going to cost? How's that going to work? I think it's an education piece, isn't it? Especially if owners or investors are new to hospitality, those franchise agreements, they are legally binding.
And of course, that actually is an interesting point on legally binding, because all of them now will have an arbitration clause. It's a fantastic incentive in the sense that if you're the brand, because very few owners are going to want to put the money into arbitration. There is the litigation risk, and there's no publicity during the process. So the things the owner is unhappy with will not be in the public marketplace. And given the restrictions in the agreement in terms of confidentiality, and I'm not saying all these are unreasonable, but there are restrictions against talking to other owners and things of that nature. So if you're dealing with a brand that doesn't have an effective owners association,
okay,
and I mean one that hasn't drunk the Kool-Aid,
yes,
if you don't have that, you have no avenue to go other than a very expensive one.
Yes,
to challenge.
Yeah.
In theory, that doesn't mean on a commercial level you don't.
Of course,
you can't start a campaign, but it's on paper. It's tricky.
Yeah. It's interesting you do mention about the associations, and I think that is an important piece for an owner if they are to be educated on, first of all, the negotiation process. They get to a point where they're happy to sign. It's that then ongoing engagement with the brand. So when challenges happen, and let's face it, over the course of 20 years, there's going to be ups and downs, as then knowing how you can escalate that, how you can leverage your relationship to be able to get to a point of mutual agreement without necessarily having to go down the route of arbitration, which, you say, can be very, very expensive and not necessarily positive. And owners are often told to negotiate everything up front. In practice, where does leverage still exist after signing, and where does it realistically just disappear?
Well, it's not just because I'm a lawyer. If you don't negotiate everything up front, particularly on a franchise, once you've signed it, that's it. That you're there, you've got the agreement. Semi-accommodating developer who's now gone off to deal with the other 50 projects they've got on hand. You're not dealing with the person that gave you the comfort. So unless you've got the comfort in your agreement, and else you've got very comfortable with the risks,
right? Okay,
that you're stuck with it.
Yes, yeah. So unless it's down there,
that doesn't mean, yeah. The brands
is down there in black and white.
Yeah. The brands can listen, but it depends on how many hotels you've got with them.
Mm-hmm.
I've terminated in circumstances where there have been a lot of hotels with a particular brand, and we still ended up paying a huge amount of money. So it's it's got to be borne in mind.
Yeah, completely. And to balance that, where do brands have legitimate constraints that owners sometimes underestimate?
Well, there are certain provisions that if you don't negotiate anything else, you need to look at your transfer and assignability provision, your ability to sell, because the brand has a legitimate concern. They're not going to deal with a sanctioned person. Some of them also have provisions that they might be able to terminate if you pay liquidated damages, but if you sell to a competitor, that goes up by another 50%. So the restrictions on an owner, they've got to balance those against the return, the benefit of being the brand. Now, banks, lenders, they like a brand because it gives them comfort. If the project doesn't work out and you want to sell it, the brand is a downside because it's viewed as incumbent. So I suppose the interesting question is which clauses go to value, and the ability to be able to terminate will probably be worth a couple of percentage points on your fees. They could be worth as much as that. So I think being involved with your valuers and the people who produce your feasibility is important.
That's very true. Each clause of any franchise agreement has a value, and certain things, people will see as non-negotiable. They don't want to do a deal based on that. But a lot of these are ticket items, and a brand would think, okay, well, if we're going to give this, then we're going to take that, and I suppose there's negotiation from both sides. How often do performance or compliance obligations tip from being operational issues into legal ones? What tends to trigger that shift?
Well, if the world could come up with a seriously enforceable performance test, that would make a huge difference. But the difficulty is a performance test based on the competitive set in your budget. If you're in a management agreement, if you're in a franchise, it's a different issue. I have seen some growing transparency in franchise agreements, but only if they feel they have to. There's more talk about transparency than actual transparency with what the brand is going to be charging you. It's worth looking actually across a brand which has more of a global presence, because there'll be jurisdictions in which there's a larger disclosure requirement than in others. So it may be you can get a better disclosure, probably get a better termination right in different jurisdictions.
It all comes down to how important the asset is to the brand, isn't it? I would imagine, if it's a key location, if it's a new brand or it's a particularly large hotel, the owner's in a place of strength to be able to negotiate that. If we step into a secondary and tertiary city, the balance, I guess, shifts somewhat.
Well, we are in a world where, because of legislation, some relevant legislation, some hotels are becoming stranded because they've got so much capex, or they haven't got the right cladding, or they need to
especially with ESG. Yeah. Mm-hmm.
Yeah, exactly. So there's the risk of that. I do think that some brands are getting slightly abandoned by some of the traditional brands are slightly abandoned by the new shiny products that are coming through.
Especially with so much M&A.
Yeah.
Mm-hmm.
So I can't help but think, and I do usually act owner side, I can't help but think that you have invested a huge amount of money into your assets. You may have done everything the brand wanted when this started, but there isn't an obligation on them to make sure that brand is maintained. If it's a new brand, you want to make sure they're opening other products, so there's some buzz around the whole thing, and that it is the international draw that you may want it to be. If it's an older brand, I don't think as much attention is given to them, and it shouldn't be attention that an owner has to pay anything more for. It should be part of maintaining the franchise system and maintaining the brand. And there's some drafting you can do to try and get there, but you've got to believe in your brand.
Yeah, 100%. I mean, you'd like to think that a brand company, if they own a brand, would invest in it. But I suppose as companies get larger and larger, being able to do that, it's like with any big company, the bigger they are, the slower it takes them to get to where they need to be. So it's all to be taken into consideration and weighed up at that point of negotiation, and to think, okay, is this risk that I'm willing to bear? Certainly challenging for those older assets. And on that, I mean, you've spoken previously about PIPs as a major capital risk, and as we know, as the properties get older, there's a need for reinvestment. In practice, where do owners most often underestimate the legal and financial exposure created by these PIP clauses?
Well, it's slightly different on a franchise. Well, on most franchises, you won't have the same level of requirement on an FF&E reserve, because it's all your business, and it's not. There's a slightly different interest in a management agreement.
It's a sensible thing to have, but if you don't have it, it's maybe not mandated or audited. Or
well, I think it's also understanding that 4% of revenue is not going to cut it. It's probably not going to. It's not
nowhere near.
As you need year on year. So
Correct.
Whatever you've put into your feasibility is probably not going to be sufficient. Then hopefully there will be some restriction on your obligation to implement brand standards if they involve major capex or even minor capex. It depends on what it is. If it's a change in the software, that's one thing. But for example, I know owners going into franchise agreements at the moment where this brand is going to revamp all its tech. So you're paying for your system, all your electronic systems, and you don't know whether in the next 2 years you'll have to pay that sum again for a totally new set.
Are there Any examples where PIPs genuinely protect long-term asset value, and how should owners distinguish those from purely these brand-driven upgrades?
Well, you will need to refurbish. The question is the extent to which you're expected to refurbish, whether it's maintenance and refurbishment, or whether it is significant changes to the style because the brand has decided it wants to be up or down. That's an interesting one, because if you think about it, there are certain brands that were in the luxury category that now are, I suppose one politely would call it sub-luxury, or luxury has risen, or they brought in another couple of luxury brands. So where does that leave?
So there's the portfolio changing and these different swim lanes. Yeah.
Because when you're making a very significant investment, whether it's on a refurbishment or whether it's on your entry into the brand, you do want to know that you're going to have a luxury product to sell or a 4-star product to sell. Or a collection.
Well, yes, going to impact your ADR, your RevPAR, what you've forecasted, what your exit is. Everything is linked, isn't it?
Which is why distinguishing between commercial and legal risk is a tricky one, because they are very intertwined.
With all these changes, I really feel, I know you said in certain areas, certain companies, maybe it hasn't got the guts that it's got somewhere else, but these advisory councils, I think, talking about it, raising these concerns as early as possible, having open dialogue, because the reality is that a lot of brand companies don't have the answers, and they're changing and they're evolving, and they've got to be fit for purpose and fit for the market. And if it isn't, that's a big problem, and it can add, and land yourself in a lot of challenges. And these disputes are rarely planned for. What types of disputes do you see most often between owners and brands, and what usually sits underneath them that could have been addressed earlier?
Well, there's the money. And with money, whether it's capex or fees, sits transparency. There are changes in the product which may well be beneficial for the owner, like using the cloud and things of that nature. They may not all be beneficial for the owner, but it suits the brand. And I'm still digesting what some of the loyalty schemes are becoming, because not as far as I'm aware, none of my owners have seen benefits coming through the system, because that loyalty scheme is growing and bringing in all sorts of very interesting other entrants and using that loyalty scheme for other purposes and in other markets. It's interesting to see how that'll play out, because where are people using their points? Where can they use their points? Is it ultimately going to cost an owner?
Who's paying for it at the end of the day?
Yeah. And the owner understanding that, if it's, they can probably work understanding how much occupancy they have to get the loyalty returns, but it's the other bits that go with the loyalty scheme. So I know many owners that wouldn't think giving a bottle of champagne if the room is late to a guest. You can't do that too often. So it all mounts up.
And I guess there's so much difference between the brands. And so if you're an owner portfolio of hotels of different brands, trying to keep up with all of these different systems and programs is near on impossible.
So to go back to your point as to when people are coming to us, so it's the money factor, it's the cost, it's the owner's perception that it's non-delivery. That might just as easily be about the location and the type of product as it is about the owner's use of the system. And sometimes it will be the owner's use of the system. But often that's where they expect a brand to hold their hand.
Holding hand is one thing. It's got to be mutual. Owners need to engage. They need to open up those challenges of communication. It needs to be constantly engaging with the brand, because otherwise their voice won't be heard, and they need to take the advice and the support and so on. As you're saying, if it isn't the right level of support, then conversations need to be had. But it's a partnership. I always relate it back to, it's like a marriage, and 20 years, gosh, well, we see the divorce rate. There's a lot of owners doing very well out of the systems, and of course then there's a range. There's others that simply aren't. But I'm also confident that with the right education, the right guidance and support, if If it's a sound hotel, it makes sense. It's not a vanity project. Then, you can get to where you need to be as long as you're doing it together. I know so many owners, they'll sign a franchise agreement and that's the last thing you hear from them. And I always used to say, gosh, everybody gets their bill at the end of the month. And it's the same. You get out what you put in. Exit is often assumed to be clean and straightforward. You and I both know that's not the case. From a legal standpoint, what most commonly complicates exits or transfers, specifically in franchise hotels?
Quite, as I was like to allude to earlier, quite reasonably, you're not going to transfer to a sanctioned person. The brands will try and limit your ability to transfer to a competitor, which you can see some rationale behind that. But what most offends me is the degree of control in the first draft you will see with regard to transfer provisions.
Yes.
I don't believe a brand should ever be of the view that they can review all the financials. If the hotel is being purchased and the debt is within the ratios in the agreement, I don't believe it's right that it should be delayed whilst that is reviewed. Of even greater importance, I don't think the brand should be entitled to go in and do a new PIP because it's a change of owner. Now, I perfectly understand their commercial view that with a new owner, there are a few things they'd like tidied up, a few things that they haven't insisted on in terms of brand standards. But my view is if you're selling the asset, if there's an outstanding PIP, absolutely. But
Sure.
You don't give them the chance to rush in and do a new one so that they can reduce the seller's purchase price or increase the incoming owner's burden because they think it's a good opportunity to get some changes.
Well, yeah, such an event would definitely impact the economics and the timing. I guess as long as an owner is operating the hotel or whoever operates it for them within the words of the agreed franchise agreement, so, it is up to standard, maintenance, PIPs and so on are being carried out within the necessary time windows, that need for a PIP on sale should go away. Realistically, there shouldn't be a case that could be made internally to say we can do this because it's up to brand standard, and guess what? Our guest satisfaction scores or whatever the metric is per brand are good or strong.
A transfer provision is really important because particularly if you've got a set of owners that may transfer between each other, you don't want to trigger change of control. There are different things you need to look at just to make sure that you can trade your hotel as you expect to be able to trade it. With respect for the brand, but also, and actually, as I've alluded to before, when you're entering into the agreement, is there value in negotiating an early termination right if you can? Brands are going to raise their money in public markets on the basis of the long-term income that they're expecting from an agreement. So they're not going to agree very easily. But there are certain circumstances in which they should want to behave well to assist a transfer, not block it or delay it.
Completely. I think it's really, really important that the owners take away from that. In a franchise agreement, there will be clauses that talk to a transfer. Understanding that in advance, that shouldn't be a surprise when the point comes to transfer, because sometimes it comes a lot earlier than they were anticipating for whatever reason. To then suddenly open up that clause and think, okay, what am I entitled to? What am I not? Seems crazy to me. That should be really dealt with before signing. And if there's points that need to be negotiated, it should be done at that point because it all builds into your future financials.
Well, the person who has the tens of millions invested or more really should be able to realise that it shouldn't be stopped because of a license agreement or delayed because of a license agreement. Hopefully the buyer is well versed enough to understand the process. So I'm not discounting a brand's concerns at all, but I don't think it should be a brand opportunity. And still in some, less so with the big brands, you will see a right of first refusal to a brand, which is nonsense. All it is a delaying mechanism. If they want to bid, they can go out in the market and bid. And I'm sure they would be very pleased if they come up with a stonking offer.
So, Felicity, if you were advising an investor reviewing a franchise asset today, which parts of the agreement would you scrutinise first and why?
Definitely go to CapEx and brand standards and the requirements to make changes. I'd also probably encourage an owner to look at the concessions they're being given, if it's a construction or it's a refurbishment, because I've seen concessions being given that would cause a trouble on a quality assurance rating. And therefore, you might find you're not meeting your targets and being brought down because your swimming pool is too small or something of that nature, which sounds quite lightweight. But actually, if you think, well, I got the concession when I went into the agreement, sometimes people just haven't thought, well, actually, that will lower my rate on the quality assurance. So it depends on your product. I would always look at the transfer provision and would always try and include some termination provisions. So it's really it's the CapEx, the termination and the transfer that I think are fundamental. And owners are often told there's no negotiation on a franchise agreement.
Well, of course, that would be the starting point.
Well, it's whether you're prepared to do a Monty Python Black Knight, really, and actually keep going, because there are a number of things that can be changed, commercially should be changed, and it depends slightly on the brand as to how sympathetic they are.
It has to be of mutual interest, doesn't it? It can't be one-sided on either to either party. It's understanding what those are, and everything is up for negotiation. And if it isn't, maybe that's not the right brand or the right asset. And
the two phrases to be really wary of is our interests are aligned because of the fee structure. Well, three actually. I've never been asked for that before. It's something that is quite often used in a development process. And the other is that we wouldn't do that because we'd upset all our owners. Well, if it would upset all your owners, why are you insisting on a provision that allows you to do it?
Okay, let's look ahead a little bit as brands continue to evolve and systems become more complex. Where do you see franchise agreements becoming more challenging for owners over the next decade?
I think the loyalty program developments are something to keep an eye on. The new brands challenging the old brands, the whims and styles that change, keeping something current. These agreements are really very long. You could have a lesser life sentence, actually. But if it's not working, they're very, very long. If it's somebody who's worked the system really well, that's very pleasing. I'll also see more of owners wanting their own independent brands in the restaurant, being able to manage the F&B, being able to leverage their position, which is probably easier in franchise agreements and gets a bit more complicated on some management arrangements. You'll see the brands getting more into different products, such as we see Accor expanding into restaurants, and we see Marriott expanding into everything nearly. So it's a question of being able to make sure that your hotel has some priority with them. The next step, it's difficult because there's a combination between the new agreements with new shiny brands and the existing hotels. Probably not so much the luxury market, but the sub-luxury market. The development of branded residences is going to be very interesting already, and is going to get even more interesting, I suspect. But there'll be less UK, I suspect.
Yes.
Brands, a brand putting its brand on just residences. So where will things compete? Not to mention that there's been recent mumblings in the press about OTAs and reservation systems and things of that nature. Ideally, the brand's reservation systems will step forward further.
Well, I think the challenge is going to be as everything moves upstream to generative AI, that's going to open up a whole world of opportunities or challenges. Who knows? But I think from an owner's perspective, their ability to impact that is going to change. So it's going to be interesting to see how the brands react.
Where you have a brand from a country where there be tariffs, where there are different approaches, and you are subject to withholding tax, gross ups. You need to be careful when you go into these things. And, there's a talk of a brand spinning off and listing in New York.
Right.
So rather than being a European originated entity, there'll be a part US entity. And I do think there's some interesting things to come out of those arrangements.
Where the chosen tax dominion is, and if that changes, depending on what the treaties are that are in place, could have a huge impact financially.
Well, I heard a recent one where it was a very simple, we're just going to change the provider from this group company to that group company. And my client was just about to sign it because they can do that under the agreement. And I said, well, hang on a minute, they just told you what the holding tax implication is. And actually, it was another 15% on the particular, on all what should have been reimbursed. So it had gone from 15 to 30. There was a way of mitigating that. But if the client had just signed without making the investigations beforehand, they would have been stuck with that until they realised that they needed to do something to mitigate it.
Right.
And that wouldn't have been, to be fair, the brand were great. Once there were questions on it,
sure,
they did help.
But no one is going to be proactive about that. It's good for the owners to understand and be knowledgeable on this, or things change as well. What's the most misunderstood clause in franchise agreements?
Probably the liquidated damages. When an owner thinks they can terminate on the same basis that the brand can terminate. And then when you reread it, you discover it's the brand can terminate for your breach.
Mutual. Right. Okay.
So I think that's quite important. Not that anyone wants to pay the degree of liquidated damages anyway, but it is. I've had owners who say, at least we've got a termination right. And you're thinking, I think we need to reread that one.
What's a red flag you wish more owners spotted earlier?
In the documentation, it's back to the transfer performance test, and the CapEx. So those are the three that really are ones we should always try hard on. In terms of understanding the brand, understanding what it's going to cost them, having a good feasibility, entering into it, those are things that people need to look at very carefully. And if an owner doesn't have a feasibility, that's a massive red flag to me. Because I find it very worrying as we go on. That
I would find that extremely worrying. Yeah. I suppose there is a range of quality of feasibility studies, and sometimes if there's a desire to get a project over the line or get that particular asset, sometimes people think we'll deal with that when the time comes. But that's obviously the incorrect approach.
And I'm sure that most owners will follow the don't give a guarantee. I don't really think often if there's enough equity in the property, I don't think the brand should be seeking guarantees as well.
I suppose as long as people pay their bills, as we know, things can change. We've all lived through COVID, and let's hope we don't have that kind of crisis again.
Well, I will say the brand affiliation was always really good because the perception of the travelling public is they were safer staying in a branded hotel than an unbranded hotel.
Right, yes.
And so it's ESG requirements and things of that nature, it helps put an owner in a strong position. I think there's a fine line between what is just for the benefit of the brand and what benefits.
Yeah, that public perception of what the brand is, as you said, the standards, and those standards may be around health, safety, security, so depending where you are in the world. And it was interesting because on the flip side as well, from the brand piece, when COVID hit, of course, liquidated damages were always calculated based on the previous year's RevPAR, for example. And as all of the hotels were empty, owners then got to a position that they could have exited with very little liquidated damages. So I don't know who that was a lesson for moving forward. But
if that was carefully drafted, it was quite useful to a number of owners.
Correct.
In some cases, the brands were very good in the way they stuck with the owners. So that was
well, that's it. It should be a partnership, shouldn't it? I mean, the ideal utopia is a sensible franchise agreement is signed, it's put in the drawer, and then the relationship carries you forward. But it's not always the case.
It's interesting that the reference to partnership, because as a lawyer, it gives you nightmares. But in terms of people working together, the assumption that there is good faith from the other party, particularly with documents done under English law, irrespective of jurisdiction, it's increasingly observed now, but there isn't actually any legal obligation to act in good faith. And it's interesting that some of the brands go as far as to say it can be their reasonable business judgment, which, unsurprisingly, is completely in favour of them. So it's not a balanced partnership from the start. But that doesn't mean that with the right brand, you can achieve a lot.
Felicity, thank you. What really comes through in this conversation is that franchise agreements aren't static documents. They're living frameworks that shape risk, flexibility, and outcomes long after the ink has dried. Felicity, thank you for your time and insight, and thank you for listening. I'll see you in the next Boardroom Conversation.